Ladies and gentlemen, a very good afternoon to you all and also to our audiences watching Asharq, different media platforms. It is no secret that the VC landscape has been fraught with significant uncertainties stemming from a combination of geopolitical tensions, soaring inflation, and rising interest rates. How should founders approach fundraising in a more constrained VC environment? What do non-traditional investors bring to the table? Which segments of venture capital seem poised for the biggest corrections or declines? And where do we see enduring strength and resilience to weather fluctuations? These, ladies and gentlemen, are questions that need to be addressed at these interesting times as we witness the mix of opposing forces pulling and pushing the VC space amid exciting and promising possibilities by artificial intelligence and deep tech. It will be most intriguing to anticipate the outcomes for the coming months and years. I am honored to be joined by panelists who will be able to give us perspectives from the US, from China, and from Europe. Please join me in welcoming Catherine Chen, the founder and general partner at US-based Market X Ventures, Anu Hariharan, founder and managing partner at Avra, Dr. Klaus Hommels, the founder and chairman of Europe's Lakestar, and Ming Wang, the founding partner of China-based Future Capital Discovery Fund. And Ming, maybe I'll start with you. Do VCs in China nowadays have access to dry powder, and how do you see the outlook?
Okay, I think this is a very tough moment for Chinese VC because number one, for the US dollar fund in China, it's very hard to raise capital from US traditional US LPs like endowment and pensions. So the dry powder from US dollar VCs is I think it's in the lowest level for the past 20 years. And for the RMB focused fund, it's also quite difficult to raise money because the market and also because the government have some hard requirements if they give you the money. So I think this is a very tough moment for Chinese VC. Yeah. So my takeaway is that only the best can survive in this cycle. Yeah.
Klaus, is the situation any better in Europe for VCs?
Look, I mean, we were never spoiled, so our expectation is probably the lowest in the world. Yeah. So because you look at the classical sources in the US are endowments, which don't exist in Europe. Yeah, and then the second biggest is insurances that don't invest in Europe in VC, and the third one is pension funds. And in the US, the classical allocation is 15%, and in Europe, it's 0.02%. So I think we have always been operating under more adverse environments. So I think there was not so much air below us. So it was, it is what it is, right? So the guy that stops fighting last wins.
You've always been working and fighting for pension funds to enter the space in Europe. Is it a regulatory problem?
Yeah, it's to some extent it's a regulatory problem and it's a cultural problem. Because the risk of adversity is still higher. So if you think about it, in the US, the family offices, the owner family offices, they've never seen their fabrics being destroyed because war never arrived. But in Europe, the generation that is the very old heirs of the family offices, they are still the entrepreneurs that build everything and saw everything destroyed. So that is still it's hardwired with that generation. So it is a little bit less open to that asset class.
I know the situation looks rather different in the US. If we look at numbers, we see that there is ample dry powder with VCs, but it's not being deployed, especially if we're talking about new businesses. We see, okay, the reserves, existing businesses. What do you make of that? Is it a combination of factors, and what's the outlook in your opinion?
Yeah, I think in the US, there are really two forces. If you take the spectrum of how spoiled the US is, we were probably very spoiled right in the last many years. But there are two things that have happened. Yes, we have a lot of dry powder, but there are two things. One, I think late-stage companies still need to correct prices, right? Public markets have corrected prices, but late-stage hasn't, which will happen over the next 12 to 18 months. Second, the fundraising market for VCs is really tough. So while the funds have a lot of dry powder, they want to hold on to the dry powder because they don't have high confidence that they can go back to market next year and raise. And why is that? Well, the US endowments, which is the largest source of the LP days, have no money. They're over-indexed to venture. We've had a 3-year IPO dry spell. The first IPO that went through was Instacart and Klaviyo. That doesn't really open up. You know, we need Stripe and ByteDance to go IPO. Only then they will open up liquidity. So US endowments don't have much money. The pension funds are also slowing down. And so there's not a lot of capital for these funds. And funds have gone too big, right? They went from $1 billion 14 years ago to $10 billion funds. So therefore, they're holding on to the dry powder, saying we now need to look at 3 to 4 year deployment cycles. And so they will delay it. And I don't think there is clarity on when that is going to change.
Catherine, amid this tight IPO environment, do you think VCs can build IPO market before IPOs?
Yeah, that's a great question. So I run MarketX, and we actually started out as a fintech platform trading secondaries. So as Anu mentioned, right, companies like ByteDance and Stripe hasn't gone IPO yet. However, on secondary markets like mine, and also there are 50 other secondary markets out there, I see a lot of trading activities for names such as Stripe. We see almost like daily activity for shares of SpaceX to be traded. So I think there's actually more interest now to trading secondary market for some very well-known names because number one, we know the underlying math makes sense, right? These companies are still producing very good ARR, and they're just waiting for the IPO market to come back. So in the meantime, we see investors rushing to the secondary market. However, in the last few years, I would say valuation have been very, very tough. So we have seen discounts of up to 80-90% now happening in the secondary market for some of the names that have raised at tens of billions, and now really we're looking at the lower single billions.
Ming, your company, your fund invests in early stage companies also. Do you think this is a good time to invest in early stage in China? And what is it that you will be looking for when you look at a pitch deck?
Okay. Number one, I think this is the right timing because you look at those, because we focus on technology companies. If you look at over the past decades, the best technology company usually gets started in the very low market, very tough market, including Google, including ByteDance actually also started in the very tough moment. So we think, and also the valuation for the early stage goes down a lot. So I think it's a good timing for startup business and also to invest in early stage. What kind of characters are we looking for? I think in this tough market, only the best or only the number one can survive. I'll give you an example. We were the first investor for China's leading EV company called Li Auto. Yeah. Now it's a $40 billion company. We were their angel investor. When they started, there are more than 500 brands of EVs in China. And now, how much left? 30. And the top 3 brands account for more than 60% of the total sales. So only the best can survive. So when we choose entrepreneurs, definitely we want to choose the winners, number one in these sectors. Yeah.
I'll come back to you on EVs in a bit, but I want to go to Klaus and ask him what he would be wanting to see. Are you going after the seasoned founder? Blake Starr has just decided to invest with Spotify founder in a healthcare startup. Is this now important? Is it a discriminating environment against new founders?
Well, look, I tend not to overinterpret the things. Look, in conferences, normally you are always asked about the last 3 months, the next 3 months, and the last 3 months. But look, in general, I sense that the big companies were for like 7 to 10 years in my portfolio. So honestly, I don't care. So if a great gifted founder has an idea, he always founds things. things, no matter where the interests are, the cross currency is, or whatever. So, and I do what I do out of the fascination to be allowed to be a part of a journey of a founder. This is the cool stuff. This is the real currency, and this has very little to do with external factors. So, and that's why I think, yeah, with doing that for 20 years, you have lost the nervousness of the moment. Yeah, you are way more inclined to appreciate the journey as such.
Tell me about what's cool in being the chairman of the NATO Innovation Fund, NATO being a military alliance now in the VC space. Can you explain that?
Yeah, so it's pretty simple. Our entire VC ecosystem is designed in a way that we are not allowed to invest in dual-use companies. Yeah? And I was in several years of the opinion that there has to come a certain aspect of digital sovereignty in a variety of senses, meaning in terms of having a known SpaceX in Europe, having own payment systems, having own operating systems for drones. These are things which are essential to successfully run and defend a democratic authority, so to say. And when we saw that the venture funds are not in a position to finance that, it was a logic consequence that coincided with NATO's desire to back with 1 billion coming from the Ministers of Defense the investments in dual-use companies. So, and this is what we do. So we are trying to engage and finance technologies that enhance the defense capacity of NATO, and we want to use it to push the ministries of defense to help with procurement, because procurement is the real issue here. It can easily take 4 to 10 years historically, because that's what the time frame was when a tank or a plane arrived. And now with software, you have to procure very fast and instantly. So it is fascinating. Yeah, because unfortunately it has actuality of the moment, but it's also something where I think Europe had a certain kind of naivety for a long period of time, and now it's a time to change that a little bit.
And when you hear of digital sovereignty now and geopolitical tensions, and we're here in the Middle East, what does this area represent in terms of perhaps connectedness between China, between the US, in the context of what our other guests were saying?
Well, I'd say there are two things that are counterintuitive to most people, right? If you hear the news, it feels the world is actually no longer global, and we're getting more siloed with all the geopolitical tensions. But actually, if you look at it from the startup lens, what post-pandemic the world has done is actually made software development more global. I can't name a single US company that started in the last, 5-7 years that has scaled beyond 200 people that does not have presence outside the US. Not one. And at Y Combinator, which is where I was for the last 10 years, I would say in the last 3 years since pandemic, more than 52% of startups recognize themselves as remote. Why? Because they knew they cannot scale engineering development in the Bay Area. It has become impossible to scale engineering development in the Bay Area. So therefore, invariably, startups that start in the Bay Area, when they hit 100 people, they look at Vancouver or they look at Argentina. And the world is just going to be more global. That's how, at least engineering development is. Because if you're a startup and you're not tapping into that, you're at a disadvantage. You have because talent is everywhere. There are smart, talented people everywhere, but they don't have access. And the post-pandemic world has changed that. And if you just read the geopolitical news, you won't see it. Right? And I think more like Deal, one of our most successful startups, which does remote payroll, is a US-based startup. But where do the founders live? In Israel and London. Their engineering team is all over Europe. And the customers are in the US. So the next generation, in the next decade, the really successful startups are going to have global presence, even if not their customer base is global.
And what's your advice to startups that managed to fundraise in 2021, have enough runway, but perhaps struggling with slower growth at the moment? What do you tell them?
Yeah, so two things. One, if you raised in 2021, you're probably sitting in a great valuation with a lot of money. But the crisis is when startups are made. And therefore, if you can really implement lean operating principles that help you scale, this is the time to do it. There's no founder that's told me that I cut the team by 50% and it didn't work. It's usually, I moved faster by cutting it by 50%. So you have to be prudent about doing that. But that, I think, most investors here will say, and founders will say, every investor says that. I think the real thing to ask is, do you really have a business? And I can tell you that probably 60 to 70% of the unicorns from 2021 don't have a real business. Meaning, they've gotten to 5 to 10 million revenue, but there's nothing beyond that. There's no pathway to scale to a 100 million revenue business. So you have to really ask the hard question, and there's no shame in saying, this isn't working, I'm better off returning the remaining money and starting something new, because guess what? There are really new companies and ideas that require to be built. And I think that's where we're seeing the struggle.
Catherine, are we going to witness a unicorn crisis?
I wouldn't say it's a unicorn crisis, but we do see a lot of companies now obviously entering a new time, right? We have 50% of the companies that raised at extremely high valuation. Now either they're raising at a much lower valuation or they're cutting staff by 50%. So in the last couple years, I think on one hand, I do want to talk about what's going on in Silicon Valley, right? I just came over here last weekend. We had the MIT AI Day. Well, OpenAI, Greg Brockman's company is 90 billion now. So if you have an AI number next to your company, you're raising pretty well still, because there's so much dry powder in Silicon Valley today. And not just Silicon Valley, right? The global capital is looking to deploy in AI. We did 6 deals this year. Half of them are AI deals in Israel. We did 1 deal in South Korea, focused on GPU computing. We also did a deal that's actually very similar to what Anu was talking about. Founders are in the US, but the rest of the engineering team is in Estonia. The rest of the engineering team is actually in Czech Republic.
Is it clearly a bubble?
I don't think there's, like I said, I think there's 50%, 50%, right? 50% of the companies that are still raising reasonable price, at least we gave money to companies that are raising at 5, 10x multiple. However, there are definitely quite a few late-stage companies. I wouldn't have to name who it is, but as you know, there are tens of billions with very little revenue. So that is obviously the case. So people always talk about, is AI hype or not? We just have to wait and see. And then lastly, I do think there are quite a few companies today that are focusing on very basic infrastructure-related areas. We invest in next-gen transportation, fintech, vertical SaaS, and now semiconductors back in fashion again, right? After 10, 20 years of quite a bit of a slump, now we see companies are now focusing on supply chain for semiconductor. What's going to happen if China takes over Taiwan, right? That's on everyone's radar. Are we going to have to reshift the supply chain from Taiwan to elsewhere? Is it Eastern Europe? Is it parts of Asia? So we're looking elsewhere for opportunities for the next unicorn or decacorn or trillion-dollar company. I think everyone wants to eat NVIDIA's lunch, so we'll have to see where the next unicorn comes from.
Klaus, I want to take this to you. What's your view on this, what some would call a unicorn crisis? And do you see bubbles in the AI segment?
So typically, as long as we have these tech cycles, you always had hypes. Yeah, and if you look at it more scientifically, you call it IS curves, which initially create a lot of hype in order to mobilize the capital. And once the capital is mobilized, you roll it out, and then it becomes real businesses. So it is a very usual thing to happen. And I cannot answer that because I don't know where this AI journey goes. There will be a segmentation of the market. Some require a lot of money when you train these models. Some might be efficient with way less capacity, because I think when we ask around here how much percentage of Excel we are using, probably like 10% of the capacity of Excel, and we're still all happy users and pay for it. Might be the same with some technologies in AI, especially if you provide a discriminated data set. I think the data set might become more relevant than the technology below it. So in the case of NATO, what you are addressing, Daniel has a differentiated data set because he owns the entire chain from the cloud where the data is stored to the physical devices and the place where the treatment happens. So having this kind of data set, you probably can still have very, very sophisticated and valuable companies with a very less demanding technological framework, so to say.
Ming, I told you I want to go back to you with EV, and I want to ask you here about another hype in the market, the EV sector, and where's real business and where's the hype. If we look at quarter 3 and 5 of the 10 biggest equity deals were in the EV space, you are seasoned in EV with Li Auto from early stage to IPO. But then we have a company that managed to raise about 40 billion RMB, close to $5 billion, and went bankrupt just earlier this month in the EV space. What do you make of all that?
Okay. First thing, I think we're happy about that because when we start to invest in EV sector 7 years ago, nobody believed the story. When we do the due diligence, we talk with the guys in BMW, in Mercedes-Benz, in Volkswagen, in Honda. They said we will crush Tesla in a minutes. So that's their view at that time. So I think now the good thing is all the industry realize this will replace the traditional cars in the next 5 to 10 years. China may be among the fastest growing market for EV. So now every 10 new car sales in China, 33% are EVs. And by year 2025, that percentage will be 70. So 70% of the new cars will be EVs. So
if you're well funded and you fail, what went wrong?
I think you need to focus on your providing the right product. So like I said, we like the founder who definitely will be the number one in the sector. What is character? We like the founder, unconventional founders, which means he can make right but very tough decisions. So I'll give you an example about Li Auto. When they started 7 years ago, all the EV players in China, the easy decision to play is we are China's Tesla. So it's easy to raise money from Sequoia, from Warburg Pincus, from all the big guys.
Okay.
But the tough decision to make is whether or not just copycat Tesla into China market will make sense. So many of these by copy Tesla's model, providing the pure battery solutions, doesn't work in China. Why is that? Because 75% of the Chinese car owner don't even have a parking slot. So which means you can't install a charging at home. So the mileage anxiety is the biggest pain point for Chinese EV users. So the founder of Li Auto decided to provide extended range EV solutions. At that time, nobody believed him. So big guys turned away, said, we haven't heard any success story about these EREV solutions. But when they launched their product, the sales is bigger than the sum of NIO, XPeng, and all the other guys because the customer know they need these solutions. So I think you need to focus on the right product strategy to create real value for your customers. So that's the most important thing.
Anwar, these testing times not only for founders of startups, but also for VCs?
Yeah. Oh, yes, for sure. I think, look, if you look at the VC cycle from 2009 to 2020, now, it was pretty smooth, right? There were no, of course, coming out of 2009 recession was hard, but it was pretty smooth till then. 2020, pandemic happened. There was no, in the US, everyone was sitting on a lot of dry powder, but they didn't make any investments in the second half of 2020. Then 21 was boom because the interest rates also went to zero. Everybody, chased a lot of investments. 22, 23 have been really hard. So, and then at the same time, the IPO window has been hard. So for a lot of venture funds, that have launched since 2014, they haven't shown exits. And so they're going back to market with not a single exit in the last 8 or 9 years. And if you didn't have an exit in 21 and during that IPO period, you're pretty much stuck now, and that really delays. So when you go back to fundraising, as I said, because the endowments and pension funds are over-indexed to venture, and they're not allocating, for the first time in 30 years, they have to tap new pools of capital that they've never met. They probably will meet only 60% of their fundraising targets. That too, these are really good funds. Most of the funds are not going to meet their fundraising targets. And so I think this is what I call the cleansing of the venture system that will happen. It's inevitable. It'll probably take 2-3 years for that to happen. So.
Catherine, let me come back to you here with non-traditional actors in the space, non-traditional players. You work with about 300 family offices. What do they bring to the table, and how do they change the ecosystem?
Yeah, definitely. So when we first start out, we look at companies that have a global impact space. So when we thought about who is going to be the biggest value-adding players, we thought about the biggest real estate companies, the biggest chemical businesses around the world, because these families are looking to innovate their home business in order to survive. So when we think about players that are not purely financially incentivized, but they want to bring, let's say, the next hydrofoil boat to their home country. They want to bring the first green polymer business to a chemicals business. They're actually more incentivized to help the business, not from just a money point of view, but let's help them find their first customers. Let's help them with government regulation. On our board, we have 3 ambassadors from around the world because we need to figure out policy, right? What is the best way to tackle policy? In fact, because we have such a large pool of family offices that's backing us, we were able to have 9 IPOs in the last 3 years. And that is kind of an unheard thing for a first-time fund. What we look for is families that perhaps they sit on the board of certain government bodies. They look for companies that hopefully will bring not just in the US and Asia, but a global presence. So another thing I'd love to mention is I think in the last 10 years or so, because so many founders have exited with hundreds of millions, if not billions, they are the ones really investing when everybody has stopped investing, right? Because they made their money from technology. They want to invest in next generation of technology founders. So what I notice in Silicon Valley is sometimes, when the masses stop, the music stops, you still see the players who want to actually build companies. They're the ones reinvesting and putting all that money to work. So with that, I am a little bit more positive about the venture market than others, perhaps. But we really enjoyed working with non-traditional money, and so far we hope to help both sides of the coin, both the founders and investors, to actually act more in unison.
We have time for one last question, and I'd like to address it to all of you, and that is which segment of VC do you see most able, most capable of weathering the current storm and the current difficult conditions? Ming, like to start?
Okay, you mean which sectors?
Yes.
Yeah. Okay, I think like I said, we're lucky to bet on the EV sectors. So what will be the next big thing? We think definitely will be the cognitive robotics. So basically, it's a combination of hardware, software, and AI. And that will be the next big thing, we think. And that's what we are focusing on. Yeah.
Klaus?
I guess defense tech, because out of sheer necessity, and about 40 billion spendings of the ministries of defense in Europe alone, which didn't exist 3 years back.
I don't go by sector at all. So I only invest based on founders. And I think this is the best time to invest, only because if you're a founder in this market and you started a company, you know jolly well it's very hard to get money, which means you're very determined. So the best companies were born in 2009, which included Airbnb and Stripe.
Catherine?
So on one hand, I echo with Klaus. I also really believe in deep tech. One of our investment thesis is focused on companies that have what they call steel demand. In Chinese, it's like 刚需, right? So we look for companies, no matter how bad uncertainties are, they're going to survive. Number 2, we invest based on numbers, right? End of the day, in the secondary market, we look for companies with a very steep discount. Some people say it's better to have some liquidity than no liquidity. So we are the ones providing founders and early investors with secondary opportunities. So based on their ARR numbers, bottom number, I'm sure that we can still find diamonds in the rough.
Catherine, Anu, Klaus, and Ming, thank you very much. Thank you very much, ladies and gentlemen.
Thanks,
Thank you
everyone.
for having
Thank you.
us.